It is 9:58 a.m. You are staring at your charts. You see the price moving aggressively towards a high. You feel the adrenaline. You think, this is it. This is the breakout. You click buy. You're confident. Then, the clock strikes 10 a.m. In a matter of seconds, the candle whips down, takes your stop, and then, cruelly, reverses back in your original direction without you. You didn't lose because you were wrong about the direction. You lost because you didn't understand the time. You just got run over by the 10 a.m. macro. Welcome to the session. I'm Thomas, and today we are decoding the algorithmic manipulation that happens right after the New York Open.
Good morning, Thomas, and to every trader listening. Take a breath. That scenario Thomas just described, it isn't bad luck. It isn't the market targeting you personally. It is a highly specific, repetitive algorithmic process. We call it the macro. If you don't know it exists, you are simply liquidity for those who do.
We have a packed episode today. We're joined by Sophie as well, who is going to help us break down the technicals of this window. David, before we get into the charts and the how-to, I want to talk about the feeling. Why is 10 a.m. such a graveyard for retail traders?
Because, Thomas, 10 a.m. represents a friction point. You have the initial balance of the New York Open established. Retail traders have spent the last 30 minutes drawing support and resistance lines based on the 9:30 a.m. volatility. They have placed their stops just above the highs and just below the lows. They feel safe, they think structure is set. But the algorithm, the interbank price delivery algorithm, is programmed to seek liquidity before it seeks expansion. The 10 a.m. macro is designed to inject volatility to unstick the market. It hunts the stops to fuel the real move. If you lack patience, you are the fuel.
Exactly, David. And technically speaking, when we refer to the macro, we aren't just using a buzzword. In ICT concepts, a macro is a specific duration of time where the algorithm is instructed to run a specific program. Usually, we look at the 9:50 a.m. to 10:10 a.m. window. This 20-minute block is often characterized by a seek and destroy profile. It wants to pair orders. If there is a pool of buy-side liquidity above a short-term high, the macro will often utilize the top of the hour to punch through that level, trigger the buy stops, and then immediately reverse to price in the opposite direction.
So, Sophie, for the listener who is new to this, are you saying the market is rigged to trick them at 10 a.m.?
I wouldn't use the word trick, Thomas. It is engineering. The market is a mechanism for moving capital. For large institutions to buy, they need someone to sell. The 10 a.m. macro creates the necessary conditions, the liquidity, for smart money to enter or exit positions. It's efficiency, not malice. But if you are trading retail logic, breakout support and resistance, it feels like a trap.
And that feeling of being trapped is what leads to the tilt. Let me tell you a quick story about a trader I mentored last year. Let's call him Mark. Mark was obsessed with the NASDAQ. He would sit down at 9:30 a.m., sharp. He'd catch a small move, maybe 10 handles. He felt like a king. Then 9:50 a.m. comes around. The market starts to chop. It looks like it's building a flag. Mark thinks, okay, continuation pattern. He loads up his position size because he wants to double his day before lunch. 10:01 a.m. hits. The news driver or the macro kicks in. The candle expands 50 points against him in 30 seconds. He freezes. He doesn't close the trade. He hopes it comes back. By 10:10 a.m., he has blown his daily risk limit. He went from a disciplined professional to a gambler in a 10-minute window. Why? Because he didn't respect the time.
That is painful to hear because I think we have all been Mark at some point. So let's pivot to the solution. If we know this window, 9:50 to 10:10, specifically the 10 a.m. opening, is dangerous, what is the mindset fix?
The fix is what I call sitting on your hands. It sounds simple, but it is the hardest thing for a trader to do. When the volatility kicks in, your dopamine receptors fire. You see fast movement, you want to chase. The professional mindset is the opposite. The professional sees volatility and steps back. You must treat the 10 a.m. macro as a no-fly zone unless you are highly advanced. Your job during this time is to be a spectator, not a participant. You are watching the crime scene, not committing the crime.
To add to that, David, this is where the concept of the silver bullet comes in. Many ICT students know the silver bullet is a setup that forms between 10 a.m. and 11 a.m. New York local time. But here is the nuance. The silver bullet usually forms after the macro has done its dirty work. You need the purge first. You need the stop run. Once the liquidity is taken and the market shows a willingness to displace in the other direction, leaving a fair value gap, that is when you strike. You don't guess the top of the macro, you trade the reaction to it.
I love that distinction. You trade the reaction, not the event. Let's dig deeper into the purge. What does that look like on a chart for someone listening right now?
Picture a 5-minute chart on the S&P 500 or NASDAQ. You see a relatively clean uptrend from the morning. There is a swing low formed at 9:45 a.m. It looks like support. At 10 a.m., the algorithm often spools up. You will see aggressive red candles pushing straight down through that 9:45 a.m. low. This is the purge. It is triggering the sell stops of everyone who went long. Now, a retail trader sees that and screams, "Breakout! The trend has changed to bearish." They sell the low. But the ICT trader watches. They wait for the candle to close. If that move down was just a raid on sell-side liquidity, the next few candles will violently displace back up, leaving that 9:45 low behind. That is the signature. The liquidity has been engineered.
And that is where the discipline comes in, Thomas. Because when that drop happens, your brain screams, sell. It looks terrifying. It looks like the market is crashing. But you have to ask yourself, did we reach a higher time frame PD array? Did we tap into a daily order block? Or did we just clear a pool of money? If we just cleared the money, the move is likely fake. It is a Judas swing. The real move is the expansion that comes after the purge. Patience is not just waiting. Patience is suppressing your urge to react to noise.
It's the difference between a sniper and a machine gunner. The machine gunner is spraying at every candle flick. The sniper waits for the target to walk into the crosshairs. I want to try something different today. I want to do a short visualization to really lock this feeling in. I want everyone listening, unless you're driving, to just relax your shoulders for a second. Close your eyes. Imagine it is 9:59 a.m. Your chart is open. The price is hovering. You feel that itch in your finger. You want to be in the trade. 10 a.m. hits. The candle explodes upwards. It's huge, green, fast. Your mind yells, "Buy it, it's leaving." But you don't click. You take a breath. You watch it hit a previous high. You watch it wick. You watch it reject. You watch it turn red and slam down. You are calm. You didn't lose money. You didn't chase. You are safe. You are waiting for the displacement. You are in control. Open your eyes. That control, that is your edge.
That was powerful, Thomas. That moment of not clicking is where you make your money. It's the money you save by not entering a trap. In ICT trading, capital preservation is the first pillar. If you survive the macro, you can trade the silver bullet.
Right? And let's outline the execution protocol for after the macro. Once 10:10 or 10:15 a.m. hits, the dust settles. Now we look for the setup. We look for a market structure shift. Did the price take liquidity and then break a swing point in the opposite direction with energy? Did it leave a fair value gap? If yes, that is your entry. Your stop goes at the high or low of the macro move. Your target is the opposing liquidity pool. It becomes mechanical. You remove the emotion because the scary part of the morning is over.
What about the traders who are listening, who struggle with FOMO? They see the 10 a.m. macro move 40 points and they think, I missed 40 points. How do we reframe that?
You didn't miss 40 points. You missed a 50-50 gamble. You have to understand probability. Trading the macro breakout is low probability because it is designed to reverse. Trading the silver bullet after the liquidity sweep is high probability because the fuel has been consumed. Do you want to be a gambler or do you want to be the casino? The casino doesn't chase players out to the parking lot. The casino waits for the players to come to the table. Let the price come to your PD array. Let the price come to your FVG. Stop chasing the bus. Another bus is coming in 15 minutes.
Brilliant. Don't chase players to the parking lot. That's going on a sticky note. Now let's talk about damage control. Sophie, say a trader ignores us. They trade the macro, they get stopped out, and now they are angry. What is the reset protocol?
The reset protocol is non-negotiable. If you take a loss during the 10 a.m. macro, you must physically stand up. I mean it. Push the chair back. Walk away from the screen for at least 5 minutes. You need to sever the emotional connection to that loss. If you stay in the chair, you will revenge trade the very next candle. You will increase your leverage to make back the loss. That is death. Walk away, drink water. Remind yourself, the algorithm does not care about my feelings. When you sit back down, you are a neutral observer again. If the setup isn't clear, you close the charts for the morning session. There is always the PM session.
I'll add to that. Check your narrative. If you got stopped out, your narrative was likely wrong. Were you buying in a premium market? Were you selling in a discount? Did you ignore a higher time frame PD array? Use the loss as data. Don't use it as a reason to beat yourself up. But you cannot re-enter until you understand why the macro ran you over.
This leads us perfectly into our challenge for tomorrow. We like to leave our listeners with one actionable step. David, what is the assignment?
Tomorrow morning at 9:50 a.m. New York time, I want you to open your chart. I want you to put your hands under your thighs, literally sit on them. From 9:50 a.m. to 10:10 a.m., you are not allowed to click a button. I don't care if the trade of the century sets up. You are going to watch the 1-minute and 5-minute candles. Watch how they wick, watch how they move fast and then stall. Observe the manipulation without the pressure of having money in it. Journal what you see. Did it run a high? Did it run a low? Just observe. Prove to yourself that you can control your hands.
I love that. The hands under thighs challenge. It sounds funny, but it works. It breaks the impulsivity loop.
And when you do that, you will start to see the matrix. You will see the algorithm doing exactly what we described. And once you see it, you can't unsee it. That is when you stop being liquidity and start being a professional.
This has been a crucial session. We covered the nature of the 10 a.m. macro, the psychology of waiting, the mechanics of the liquidity purge, and the discipline to trade the silver bullet reaction. Remember, the market is an efficient delivery engine. It is not random. It is seeking liquidity. Don't let your stop loss be the liquidity it finds. Be the one waiting for the dust to settle.
Stay disciplined. Protect your mindset capital. It is more valuable than your financial capital.
Thank you, David. Thank you, Sophie. And to everyone listening, we will see you in the next episode. Keep your charts clean and your mind clear. Disclaimer: all content in this podcast is for educational purposes only and does not constitute financial advice. Trading involves risk. See you next time.